Hello friends and welcome to StudyIQ. I am Joycey Joy and today in this lecture we will discuss about the NBFC crisis and the central government initiative that was taken recently. That is, the central government has recently issued certain guidelines on push bank lending to NBFCs. So we will discuss this in detail in this lecture. We will discuss about the NBFC crisis and what are the guidelines given by the central bank and what impact it will make, and we will also see what is lacking or what is missing in the government guidelines and what more is required and what is the way ahead. So NBFC is a very important topic if you consider any examination point of view, especially for UPSC, for RBI, for SEBI, for any banking exams, for SSC, for any exam. NBFC is a very important topic. This is because NBFC serves as a shadow banking system in Indian economy, and shadow banking system in the sense that NBFC plays a very important and prominent role in providing credit or lending facilities to a large proportion of the population in India. So not only lending, specialized NBFCs like NBFCs in the housing sector, NBFCs in the infrastructural sector, certain NBFCs also play strategic role in the Indian economy. So considering the importance and the role of NBFCs and also the employment generated, the credit or the money supply factor, considering all this, the role of NBFCs in Indian economy is very significant, and from that perspective we will discuss about the liquidity crisis and the recent guidelines issued by the central government in this regard. Let us first look into the current affair. Now, if we analyze the current affair, the central government has recently issued guidelines on push bank lending to NBFCs. Now we need to understand what is push bank lending. So here push bank lending means that NBFC crisis, that is after the NBFC crisis there was a liquidity crisis in the NBFC sector. Now we need to understand what was this NBFC crisis all about. So the NBFC crisis started with the ILNFS crisis, the increasing dues or the repayment delays with the ILNFS, which is a major infrastructural lending NBFC. The crisis started with ILNFS crisis, and this led to the overall liquidity crisis in the NBFC segment in India. That means NBFC sector in India faced a liquidity crisis. Here the NBFCs were not able to raise funds from the market, especially from the banks. The banks or the public were reluctant to provide funds to the NBFC. Now, NBFCs as a shadow banking system, they require capital and funds in order to conduct their business. But the banks and the public were not ready to provide funds. So they were facing difficulty in raising funds, and this led to liquidity crisis in the NBFC sector. Now, what is this push bank lending? Now, this is related to the liquidity crisis in NBFCs. Now, under the guidelines, the government is promoting the banks, or government is providing certain assurance to the banks as a guarantee or as a credit guarantee in order to enable or help the NBFCs raise more finance from the banks. So these are certain guidelines to the banks in order to provide credit or capital to the NBFCs. So this is push bank lending. Second one is that this is followed by the budget announcements. In the Union Budget of 2019-20, government has announced certain provisions or certain steps in order to revive the NBFCs from the present liquidity crisis, which we have already discussed previously. Now, thirdly, the Monetary Policy Committee. The Monetary Policy Committee has also made several similar announcements. So, the Monetary Policy Committee in India is responsible for framing the monetary policy in Indian economy. Now, the mandate of Monetary Policy Committee is to set up the benchmark interest rates in the economy. So, the benchmark interest rates is the repo rate. So, this is benchmark interest rate, and by raising the repo rate, the money supply will be tightened. This is because the interest rates in the economy will be high. Therefore, the money supply will come down. And by bringing down the repo rate, money supply can be raised. So, the MPC, that is Monetary Policy Committee, in its 4 consecutive reviews has brought down the repo rate or the benchmark interest rate. So this has enabled an increase in the money supply in the economy. Now the commercial banks, as a result of this, will cut down their interest rates. That means the cost of acquiring finance will come down. Now the NBFCs can raise the finance from commercial banks at a cheaper rate of interest. So even after the MPC announcement of cutting down the interest rates and the budget announcements regarding NBFC sector, no much revival was seen in the NBFC sector, or the liquidity crisis was not sorted out completely. So that is why the government has come up with push bank lending. Now let us come to the guidelines provided by the government. Let us see what does the guidelines talk about. Now, the guidelines said that the government credit guarantee on the NBFC assets or the loans will be limited to 10% of the assets value. Now, for a financial institution, especially a financial institution which is involved in the business of lending money, for them the major asset is a loan. So, a loan is a asset for a lending financial institution. Now, the guideline says that the government's credit guarantee, that is the guarantee of the government on the repayment of credit of the NBFCs, will be limited to only 10% of the assets value or the loan value of the NBFC, valid for 2 years from the purchase of the asset by the bank. So this is the first guideline. Second, the budget has set aside rupees 1 lakh crore to refinance high quality assets of financially sound NBFCs. So these are the guidelines provided by the government. Now let us see what is a tall order. So why it is called a tall order, or what is tall order? Now the guidelines that we have already seen, these guidelines have certain conditions. So these guidelines of the government comes up with certain conditions as well. Now what are these conditions? First condition is that the guidelines require the NBFCs to be AA rated. So the rating of the NBFCs should be AA, and by fulfilling these conditions only, the government will provide credit guarantee to the NBFCs. So this is the first condition. Second condition is that there should be no asset liability mismatch, or ALM. ALM here stands for asset liability mismatch. Now considering these two conditions, it is called a tall order, because even the high rated NBFCs, high rating is AA rating, even the NBFCs which has a high rating or a AA rating, they have certain ALM or asset liability mismatch. Those high rated NBFCs are backed up by banks or public sector banks. Even those kind of NBFCs has certain asset liability mismatch in their balance sheets. Now, secondly, the biggest drawback of this guideline is that these guidelines provided by the government does not answer or does not address the existing issues or the existing skew in majority of the NBFCs. This is because a small portion of the NBFCs or a certain small segment of the total NBFCs are getting all the credit or all the funds from banks. So the banks devote their funds to a special segment or financially secure or what we call better rated NBFCs. But a majority of the NBFCs which are not highly rated or which are not funded by banks, especially the public sector banks, they really require the help and aid of the government. So government does not address the issues in those NBFCs which falls under the majority category. This is because the order or the guidelines of the government has come up with certain conditions as well. So those conditions are not fulfilled by a majority of the NBFCs, and therefore we can say the guidelines itself is skewed towards a particular segment or to a minority. Now, according to the Financial Stability Report, the Financial Stability Report is published by RBI. This fact is very important for your preliminary examination because publications are usually asked in your prelims exam. At least 1 to 2 publications would be asked. So, Financial Stability Report is published by RBI. So, according to the Financial Stability Report of June 2019, 30 out of 9,659 NBFCs which are registered with the RBI account for 80% of the exposure. It means that out of the 9,659 NBFCs that are registered with RBI. So this is the number of NBFCs that are registered with RBI or RBI recognized NBFCs, and only 30 out of them, or 30 out of this huge number, has access to 80% of funds from public sector banks. And this trend has worsened after the ILNFS crisis. This is because after the ILNFS crisis, there is an overall liquidity crisis in the NBFC sector. Banks are not ready to provide finance or funds to the NBFCs. So after the ILNFS crisis, even the credit exposure trend has worsened. That means only a microscopic minority of the total registered NBFCs with the RBI are getting exposure towards the funds from public sector banks. This is because the public sector banks are not ready to take up the risk. They will provide this credit or funds only to best rated or highly rated NBFCs, of which the banks have a confidence of getting back the funds. Now, if we talk about the other sources of finance for NBFCs, one source is mutual funds, another one is insurance, third one is commercial papers. So here also we will see there is a declining trend. This is because the mutual funds or mutual fund investors are also not willing to invest in NBFCs or to provide funds to NBFCs. The insurance companies and also the commercial papers are also skewed towards NBFCs in an unfavorable manner. So overall, all these factors has led to an overall liquidity crisis in the NBFC sector, and considering the liquidity crisis, government has come up with guidelines which again makes these guidelines favorable only for a very small fraction of the NBFCs existing in the country. Now let us see what is the way ahead, or how can we resolve the issue of this NBFC crisis. So first one, NBFC lending should be accommodated under priority sector targets. We know that the public sector banks have 40% of priority sector targets. So under this priority sector targets, the priority sectors, for example, the agriculture, the educational sector, exports, housing, MSME, all these are accommodated under the priority sector. So this priority sector will get 40% of the total lending from the banks. So if NBFCs are included in the priority sector, then NBFCs will have more exposure towards formal credit from public sector banks. So this is one solution. A second solution is to expand the scope of one-time partial guarantee. Why it is called a one-time partial guarantee? Because the government is providing a credit guarantee only to 10% of the total assets. So this can be expanded. The scope of it can be expanded. The third solution would be that the NBFC should have access to cheap credit or cheap fund. That is, the interest rates to the NBFC lending should be cut down. So by including the NBFC sector in the priority sector lending, this can happen because under the priority sector lending, credit is given at concessional rates. So if NBFCs will have access to cheaper fund or cheaper credit, then the NBFC liquidity crisis can be resolved. And also remember the significance of NBFCs in Indian economy. It acts as a shadow banking. Wherever the banks or the public sector banks cannot reach, the NBFC plays a very prominent role. The specialized NBFCs also provide specialized services to the public. For example, providing vehicle loans, housing loans, gold loans, all these are done by NBFCs, and it caters to the specific needs of the public. So if the efficiency and effectiveness of the NBFCs has to be raised, then they should have access to cheaper finance at easy norms and conditions. So this is about the guidelines of the government regarding the credit guarantee, and so these are the guidelines of the government regarding credit guarantee and resolving the NBFC crisis. You can find the PDF of this lecture on our website www.studyiq.com. You can also follow my Facebook page for more video updates. You can write to me at joycey.studyiq@gmail.com for any of your queries and clarifications. Thank you.